Hello, welcome everybody to today's presentation on advanced 1031 exchange strategies. My name is Jeff Stechmann. I am the business development manager for Asset Exchange Company. Before we kind of dive in, I just want to kind of give everybody some information about today's presentation. Don't feel like you have to write every single thing down. The presentation is being recorded, so you will receive a link to today's recording if you want to refer back to it at a future date. So again, don't feel like you have to write every single thing down. And a lot of the topics we're going to talk about today, I have in PDF form. I'm going to email those out to you guys. They're really good to reference back to some of the various topics, and especially, for instance, if you're a realtor and you have a client that has a 1031 exchange need. It would be perfect, just something you can email over to them. But again, I'll get those after the, once the class is completed. And as far as questions go, I'll open the floor up to questions at the very end of the presentation, because I find a lot of times, if you do have a question, most often it's going to be covered in an upcoming slide. But if for some reason it's not, then again, at the very end is when I'll open the floor up to questions. There's a box on your right-hand side. Right there it says questions. That's where you'd want to type it in. All right, so let's go ahead and dive in. It looks like we had a few people join a little bit late. So again, my name is Jeff Stechmann, Business Development Manager for Asset Exchange Company. Kind of give you all some information about myself. I've actually been in the business for 25 years. I did a lot on the title side of the business to get my start. I'm originally from New Orleans, so if y'all hear the accent come through, please forgive me. I always tell people that, every now and then it rears its ugly head. But I live in the Tampa area. I lived in Florida for 22 out of those 25 years. Glad to say I'm a survivor, because, I've seen the really good times in the real estate industry, and boy, I've seen the really bad times too. And, hopefully we never have to see those bad times again. For those of y'all that have been doing it as long as I have, right now, a lot of realtors I talk to, just about everybody says how extremely busy they are. We had a little slowdown with the COVID earlier in the year, but right now everybody is telling me how extremely busy they are. There's more buyers to go around than there's product to meet the need of the buyers. So let's give y'all some information about Asset Exchange Company. So we've actually been in business since 2006. Over the course of our existence, we've done about 35,000 1031 exchanges. So it's all that we do. We don't provide any type of closing services. We don't provide any type of financial services. In the business, we're known as a qualified intermediary, QI for short. Now, other terms you may hear people refer to is an accommodator. Another term is a facilitator, or just simply an intermediary. But kind of in our neck of the woods here in the East Coast, people just call us QIs, again, for qualified intermediaries. Now, our main job in a 1031 exchange is we actually hold the proceeds from what we refer to as the relinquished property. So that's the property that's being sold in a 1031 exchange. Well, we hold those proceeds on behalf of the seller, the exchanger, because the rule is they can never actually have receipt of those funds. If they do, they lose their ability to do a 1031 exchange. So that's our main job in a 1031 exchange. Now, a word of caution about QIs. It's amazing in today's heavily regulated real estate industry that, at least on a federal level, there actually is no federal agency that oversees what we do. So, exactly what does that mean, right? Well, what that means is anybody out there can be a QI, right? There's no type of requirement you have to have any type of E&O insurance. There's no type of requirement you have to have any type of a bond. There's no guidelines on where you hold the proceeds. There's no guidelines on the type of funds you hold the proceeds in. So when you really think about it, it's a really scary thought when it comes down to it. So, if anybody on the line today is currently involved with a 1031 exchange, please just make sure you've done your due diligence and you're dealing with a reputable company. Now, great news when you deal with us, right? We are actually based out of California. Our home office is in San Francisco, and because we're based out of California, well, California, the state of California, actually has a state agency referred to as the California Franchise Tax Board. Now, that Franchise Tax Board actually oversees qualified intermediaries in the state of California. They do require us to carry minimums for the E&O insurance we have, the bond that we carry. We're subject to audit by that Franchise Tax Board. There's guidelines on the financial institutions where we hold the proceeds, the type of funds we hold the proceeds in. That's all overseen by that Franchise Tax Board, which is great for anybody that deals with us in California, but anything that we do nationwide, because, we do 1031 exchanges all over the country in multiple states. Well, that Franchise Tax Board has oversight in anything that we do, any of the files that we work on, any of the 1031 exchanges that we work on, because, as I mentioned, they can come into our office at a moment's notice and audit any of the files that we work on. So you do have some assurances there when you're dealing with us. And as far as our ownership goes, we're actually owned by two gentlemen. Now, they've been in the 1031 exchange business specifically for like 20 plus years, one of which is actually a tax attorney. Now, his name is Adam Skarsgård. Now, Adam is actually considered like a 1031 exchange expert. He's been called upon to testify in tax court as an expert witness on 1031 exchange. He even occasionally teaches at UC Berkeley on tax law and real estate, that type of thing. Reason I like to bring his name up is because one of the things that we offer that I don't know if any other QI in the business offers is any of the exchanges that we're involved with. If for some reason they were to get audited by the IRS, we would actually provide free audit support, and it primarily would be done by our tax attorney, Adam Skarsgård. We'd work hand in hand with the client's CPA, helping to defend the audit. So another great reason to deal with us. Now, let's talk a little bit about why investors exchange. Well, the single most reason that we see investors doing 1031 exchanges is for tax deferment. So, on average, when you sell real property, if you have any gain in the property, on average, about a third of whatever that gain is goes towards paying taxes. And that's the single most reason that we see investors doing 1031 exchanges is to defer those taxes. But what are some of the other things that we see? Well, the next point is I call it buy more property. So with 1031 exchange, one of the rules to exchanging is the replacement property that you purchase in a 1031 exchange, that purchase price must be equal to or greater than whatever the sales price was on the property that was sold, the relinquished property. So what an investor will do is by doing a 1031 exchange and not having to cut that check, not having to pay the taxes, they use that as leverage to go out there and buy themselves a better property. All right, hopefully it's going to be a higher dollar property, and hopefully it's also going to be a higher income producing property. Okay, all by doing a 1031 exchange. Now, what are some of the other things we see? Well, diversification and management relief. Well, with 1031 exchange, you're not even limited to how many properties you can sell in a 1031 exchange and how many properties you can purchase as your replacement property in a 1031 exchange, right? You could sell one property, you could buy one property, you could sell one property, you could buy multiple properties. You could even sell multiple properties in a 1031 exchange and buy a single property or buy multiple, all right? It does not matter. What matters, and we covered this in the basics class, but what matters is as long as what you're selling, all right, you're using that real property in your trade or business or you're holding it for investment, and as long as what you're replacing it with, you're going to be replacing it with any type of real property, any type of light con property that is property that you're going to use in your trade or business or that you're going to hold for investment, all right? So back to the slide. So geographic diversification is something that we see. So I'll give you guys an example. Let's say I own an investment property in California. Now, California has some of the highest property values in the entire country. Where our home office is in San Francisco, I want to say San Francisco has the highest property values anywhere in the country. I think it's even greater than New York now. So let's say you sell that investment property in California in the 1031 exchange, defer all your taxes. But instead of buying a replacement property in California, you say, well, I'm going to buy one replacement property, let's say here in Florida. Maybe I'll buy a second replacement property somewhere in Texas, and I don't know. Maybe you can even buy a third replacement property somewhere in Ohio. That way, you're not so geographically tied in to one particular real estate market. Because hey, who knows if our market here, real estate market here in Florida starts to go down again, well, at least you have that other property in Texas and that additional property in Ohio. Hopefully, those markets would not be experiencing the same downturn that we would be experiencing here in Florida. All right, so geographic diversification. Now, management relief is something else that we see. I'll give you guys another example. I have a guy, an investor, he lives in New York. All right, now he owns 4 rental properties. Now, what he would like to do, he'd like to retire and he'd like to move to Florida, here to Florida, all right? But he doesn't want to manage property anymore. So what he'd like to do is he'd like to sell all 4 of those rental properties in one 1031 exchange, all right? And his replacement property, he'd like to find maybe like a small apartment complex somewhere here in Florida that has some on-site management. Because why? Because he doesn't want to manage property anymore. So 1031 exchange is perfect for somebody like him because he's seeking that management relief, and 1031 exchange is going to provide him that management relief. Now, another thing that we see is investors will actually use 1031 exchange as an estate planning tool. Now, it's not really talked about that often, but with 1031 exchange, you're not even limited to how many times you can do a 1031 exchange, right? I could buy an investment property today, hold on to it for a period of time, turn around and sell it, do a 1031 exchange, defer my taxes, buy another replacement investment property, hold on to that for a period of time, sell that somewhere down the line, do another 1031 exchange, defer my taxes again, and buy another investment replacement property. And I can keep doing that over and over and over the entire course of my lifetime. All right. Now, what happens when you die, when you pass on? If you have any heirs that inherit your property, they're going to get what's referred to as a step-up in basis. And step-up in basis meaning that whatever the value of the property is when they inherit it, that's their basis. All of those deferrals that you would have done over the course of your lifetime, basically they go away and no one ever has to pay the taxes, right? Pretty awesome aspect of 1031 exchanging, right? And it's not really talked about that often, but savvy investors will use it all the time as an estate planning tool. Now, what's the flip side of that? Well, I just mentioned you're not limited to how many times you can do a 1031 exchange, right? So again, I could buy an investment property today, hold on to it for a period of time, sell it, do a 1031 exchange, defer my taxes, buy another investment property, hold on to that for a period of time, sell that property, do another 1031 exchange, and buy another replacement investment property. Let's just say the next time I go to sell, I say, you know what? I don't have any desire to buy any more investment properties. I'm not going to do a 1031 exchange. I'm just going to cash out and pay whatever taxes are due. Well, I'm going to be responsible for those taxes, and any previous 1031 exchanges, any deferments that I did over the course of my lifetime up until that point, I'm also going to be subject to having to pay those taxes as well, right? Because with 1031 exchange, it's not a tax avoidance, okay? It's a tax deferment. Deferment meaning that you may have to pay the taxes someday, but what? When you pass on, again, if you have any heirs that inherit your property, they're going to get that step up in basis, and they're not going to be responsible for having to pay the taxes, and hopefully they just go away. So ultimately, hopefully no one ever has to pay the taxes if you do it right, if you do it correctly. All right. So I want everybody to remember that, the whole estate planning with that step up in basis, excuse me, because it's really a great aspect of 1031 exchange. Again, that doesn't really get mentioned that often. All right. I'll give you guys an example of how the step up in basis could work. Let's say I'm the heir, all right, and I inherit the property. Again, I get the step up in basis. I'm not responsible for paying the taxes. The taxes go away. Now, I may look at that property. It's an investment property, right? And for my purposes, I may say, well, gosh, I'm going to hold on to it as an investment for my purposes because, hey, maybe it has some nice cash flow coming in every month, right? And I say, okay, I'm going to hold on to it for my investment purposes. Now, let's just say, I don't know, I hold on to it for maybe 5 years, right? So I'm getting cash flow every month, and it's in 5 years. I say, well, yeah, I'm ready to sell the property. Now, if I have any gain from when I inherited the property, that step up in basis, to when I go to sell the property 5 years later, guess what? I can do my own 1031 exchange and defer my taxes and basically start the whole thing over again. All right. So again, everybody remember that aspect of 1031 exchanging. When you pass on, if you have any heirs, they get that step up in basis. All right. Now, or what are current tax rates? Well, when you sell real property, all right, if you have any gain in the property, you're going to be subject to capital gains taxes, all right? And capital gains taxes right now are either 15% or 20%. Now, the 15% historically was applied if you were single and you had income of less than $400,000 a year, or if you were married and you had income of less than $450,000 a year. Now, the 20% was applied historically if you were single and you had income of greater than $400,000 a year, or if you were married, you had income of greater than $450,000 a year. That's where you're at the 20% capital gains tax rates. Now, the income levels have changed just recently with the latest tax reform bill, passed a few years ago. But either way you look at it, you're still going to be looking at either 15 or 20% capital gains taxes, right? Now, on top of that, you're also going to be subject to what they refer to as depreciation recapture tax. Now, that's an additional 25% tax. Now, how does that work, right? Well, the depreciation recapture tax works like this. Any depreciation that you've claimed for the entire lifetime that you've owned that property, all right, when you go to sell that property, you're going to be hit with a 25% tax just on the depreciation alone. All right. Now, on top of that, you may also be subject to what they refer to as the Medicare tax, right? That's an additional 3.8% tax. Now, how does that work, right? Well, the Medicare tax, that was passed back in 2010 with the Affordable Care Act, right? It was, Obamacare. It went into effect in 2013. It was one of the things that they passed to try to offset some of the costs of the Affordable Care Act, right? So when you do a 1031 exchange, you can defer having to pay any of these taxes. Right now, what am I not listing up on the screen? Well, I'm not listing anything to do with state income taxes, right? For those of y'all on the line that are located here in Florida, we don't have state income taxes, so we don't even need to worry about that. But if we live in a state, or even if we're selling property in a state that has state income taxes, we would also be subject to state income taxes. Now, when you do a 1031 exchange, you can also avoid having to pay the state income taxes. Now, every state kind of has their own way of you going through filling out some type of form or going through some type of process in order for you to get out of having to pay those state income taxes. I'll give you guys a couple of examples of how it could potentially work. We did an exchange for a gentleman. Now, he was a Florida resident, right? But he was selling property in California. He had an investment property in California. Now, California has state income taxes. They have some of the highest state income taxes. I think they can be as high as 12 to 13%, one of the highest rates in the entire country. Even though he was a Florida resident, all right, we don't have state income taxes, but because he was selling property in California, guess what? California wanted their state income taxes. So when you do a 1031 exchange, you can avoid having to pay the state income taxes. Now, what California makes you do is he had to complete this form, all right, and he had to send it in to the state of California in order to get out of having to pay those state income taxes because he was doing a 1031 exchange. Now, it's my understanding that he's got to complete that form every year thereafter. The year he doesn't complete that form, they actually come after him for the taxes. All right. Now, we did another exchange for a lady. Now, she was another Florida resident. I think she was selling property in Maryland. Now, Maryland has state income taxes. Well, when you do a 1031 exchange in Maryland, to avoid having to pay the state income taxes, they actually required her to complete a state of Maryland form. I think it was like she had to complete it, submit it to the state like 21 days prior to closing. We had to sign off on it, and that's the way you get out of having to pay the state income taxes. So again, every state kind of has their own way of you completing some type of form or going through some type of process in order to get out of having to pay the state income taxes. But the great news is it can be done. All right. Now, for those of y'all on the line that are realtors, you'll think about this for a minute, right? If that's your client, all right, and they're sitting there thinking they're going to have to pay all these federal taxes, capital gains, depreciation, recapture, possibly Medicare, all right. Now, if they also are located in a state that has state income taxes, they'd be looking at having to pay that state income taxes as well. And they're not talking about doing a 1031 exchange, right? It's a perfect opportunity for you as a realtor to bring it to their attention, right? Because if you can bring that to their attention and they can save on having to cut those checks, right? Now they just have that much more to use to go out and buy a replacement property, right? Now, especially for the realtors that are located here in Florida, because sometimes as a realtor here in Florida, we have so many people that like to move here, they like to retire here, right? You as a realtor, you may not even be involved on the listing side of it, right? You may be helping them find some replacement property, all right? Now, if they're selling property, let's say in New York, all right? Now, New York has state income taxes, they have county taxes, they have city taxes, all sorts of taxes. If you know they're selling investment property, right, in like, let's say New York, and they're not talking about doing a 1031 exchange, again, it's a perfect opportunity because in states that have state income taxes, it's even more an advantage to do a 1031 exchange because they're going to save on those state income taxes in addition to the federal. All right. So some things to think about, especially if you're a realtor, right? Now, how do you actually calculate what taxes are? Now, this is typically done by a CPA, all right? Now, but I'm going to show you guys, I'm going to walk you through just a real quick example, something real basic, just to kind of give you an idea of what potential taxes could be. All right, now in our example, all right, originally we purchased our property for $500,000. Now, over the lifetime that we owned the property, we actually added back in $25,000 worth of capital improvements. All right. Now we took some depreciation. Right, for the lifetime that we owned it, we took $100,000 worth of depreciation. Right. We've owned it for years, and now we're going to sell the property for $1 million. Right. So in order to calculate what the taxes are, the first thing you need to do is you have to be able to calculate what they refer to as adjusted basis. Right. And the way you do that is you take the original purchase price of $500,000. You add back in those capital improvements that you did of $25,000, and then you deduct out the depreciation of $100,000, and that's going to give you an adjusted basis of $425,000. Now we're going to sell it for $1 million, right? So we take that $1 million sales price, we deduct out the adjusted basis of $425,000, and that's going to give us a gain of $575,000. Now out of that number, how much of that was depreciation? $100,000, right? We're going to take that out because that depreciation recapture tax, that 25% tax, that's actually calculated at a separate line item. All right, so we're going to take that $100,000 depreciation, we're going to multiply it times the 25% depreciation recapture tax, and that's going to give us a tax of $25,000. Now, how much do we have left over? $475,000, right? Now, let's just say we're at the highest capital gains tax rate of 20%, all right? So we'll take that $475,000, multiply it times the 20% capital gains tax rate, and that would give us a tax of $95,000. Now, let's also say we're going to be subject to that Medicare tax of 3.8%. So we take that $475,000, multiply times the 3.8% Medicare tax, and that would give us a tax of $18,050. Right? So when we sell this property, we'd be looking at a tax bill of $138,050. Again, when you do a 1031 exchange, you can defer having to pay any of these taxes. Right now, what am I not listing up on the slide? Not listing anything to do with state income taxes, right? So again, if we live in a state or even if we're selling property in a state that has state income taxes, we'd also have to calculate that number, all right? All right, so again, realtors, think about it. If that's your client, right, and they're sitting there thinking they're going to have to cut a check for $138,050, and then whatever's left over, hey, now let's go out and find me some replacement property. If you're the one that brings it to their attention, you bring it to the table and you say, hey, that check you're going to have to write for $138,050, do a 1031 exchange, defer all those taxes. Now let's go out and find you something better. Well, that's going to be win-win all around, right? Why? Because the client's going to win, they're going to save on the taxes. And now, because they can save on the taxes, they don't have to cut that check for $138,050. Now they can go out and buy a higher dollar property, right? And hopefully that higher dollar property is going to produce more income for them every month. They're going to make more money. You win as a realtor because why? Because, hey, you look like a rock star, right, to the client. And what did you just do for your commissions? Hopefully you just increase your commissions because now if they can go out and buy a higher dollar property, hopefully you just increase your commissions all by recommending a 1031 exchange. So it's win-win all around, all right? So, again, some things to think about for you, all right? Now, let's see if I can get this to work. Okay, so what are some of the tax advantages when you sell real property? All right, so with 1031 exchange, let's recap. You can only do a 1031 exchange on property that you use in your trade or business or that you hold for investment, real property, right? And you can only exchange it for any other type of real property that you use in your trade or business or that you hold for investment, all right? It doesn't matter if it's residential or commercial to residential. It does not matter. All that matters is what? As long as you're using that property in your trade or business or you're holding it for investment, you can sell it in the 1031 exchange and you can replace it with any other type of like kind property, all right? And with 1031 exchange, it's a tax deferral, right? It's not a tax avoidance. We've already talked about that, right? If you don't continue to do a 1031 exchange, you would possibly be subject to having to pay those taxes and any taxes prior to that you did over the course of your lifetime up until that point, all right? But if you have heirs, right, they get that step up in basis, and hopefully no one ever has to pay the taxes. All right, now, what do you do about your primary? Can you do a 1031 exchange on your primary residence? The answer is no. All right, for your primary, you may qualify for what they refer to as a Section 121. All right, and the 121 works like this. You had to have lived in the property as your primary for at least 2 years, all right? When you go to sell your primary residence, if you have any gain in it, and you're single, the first $250,000 of any gain is tax exempt. And if you're married, the first $500,000 of any gain is tax exempt. Now, tax exempt meaning that you never have to pay it, all right? It's not like a deferral with a 1031 exchange where you may have to pay it someday. Basically, with the 121, it's a one-time thing. You one and done with it, all right? You don't need anybody like me to help you with with the Section 121, all right? That's just something that you claim on your tax return in the year that you sell your primary residence, okay? Now, how does the 121 work? I'll give you all a quick example. Let's say back in 2010, we buy our primary residence, all right? We buy it for $100,000. Now, we're going to live in it as our primary as for 5+ years, all right? And then in 2016, we decide we're going to sell our primary. All right, now we're going to sell it for $1 million. Now, I know everybody, that was a great deal. I don't know if there's any deals like that anywhere here in the Tampa Bay area. I don't know, maybe this is property in New York or California, all right? But we're going to keep the numbers really simple, all right? So we're selling it for $1 million. We purchased it for $100,000. So our gain is $900,000. Now, I know that's not exactly how you calculate it, right? You need to figure out adjusted basis and everything we just went through in the previous slide. But let's keep it really basic, all right? So our gain's $900,000. Now, it qualifies for 121 because, hey, we've lived in it for at least 2 years as our primary, all right? Now, we're going to sell it in 2016. Let's say we're married when we sell the property. So the first $500,000 of the $900,000, we're going to claim the 121, and the first $500,000 of the $900,000, that portion of the gain is going to be tax exempt. All right, but what's the problem? we still have another $400,000 worth of gain that we're going to have to pay taxes on when we sell the property in 2016. All right, that's going to equate to roughly about $130,000 in taxes when we sell the property in 2016. Now, what if we could do this? What if we could convert the property over to an investment property, a rental property, right? Let's say we rent the property out for 2 years, all right? Now, in 2018, we're going to sell it instead of 2016 because we've rented it out for the last 2 years. Because we're selling it now in 2018 and it's an investment property, a rental property, it now qualifies for 1031 tax deferred exchange. All right, we can actually do a combination of a 121 and a 1031. All right, the guidelines for that are you had to have owned the property for at least 5 years, and you had to have lived in it as your primary any 2 out of those 5 years. All right, so back to the example, we're still going to sell it. We're still going to sell it for $1 million. Let's keep all those numbers the same. So our gain is $900,000. All right. So what we're going to do when we sell it in 2018, we're going to claim a 121 on the first $500,000 of gain because we're still married. That portion of the gain is going to be tax exempt. We're claiming the 121. Now the additional $400,000 in gain, we're back in 2016 where we're having to pay taxes on it. Well, now in 2018, right? Because it qualifies for 1031 exchange, we're going to claim a 1031 exchange on that portion of the gain, and we're going to defer that $400,000 in gain. So when we sell it in 2018, we pay no taxes, right? Pretty cool idea, right? So that's some things to think about. I have a great PDF I'm going to send out to everybody that talks about this. All right. So again, if you have clients think that may apply to them, it'll be a great PDF I can send over to you guys. I'll get it to everybody after the class. All right. Now, who can actually do a 1031 exchange? Well, with exchanging, whoever the taxpayer is in the sale of the relinquished property, all right, that's property being sold, needs to be the same taxpayer in the purchase of any replacement property. All right. So individuals can do 1031 exchanges, husband and wives, spouses. All right. Sometimes we see this with spouses. Let's say one of the parties owns an investment property prior to being married. Let's just say it's the wife, all right? So she owns an investment property, a rental property, right, prior to being married. So she gets married, and then during the course of the marriage, she decides she wants to sell the investment property. She wants to sell the rental property, right? So she wants to do a 1031 exchange because she wants to defer the taxes, and she wants to buy another investment property, a new rental property. But in order to qualify, in order to get the new rental property, the new investment property, she needs to get a loan, all right? And in order to qualify for the loan, she has to bring her husband in because she needs his income to be able to qualify for the loan. So how can you do that when you do a 1031 exchange? Well, one possible solution might be this. You might be able to take ownership in the replacement property as tenants in common. Now, hopefully everybody knows what tenants in common ownership is, but for those of y'all that don't, just basically the way it works is you can own a certain percentage of a property when you do tenants in common owner. So what you could possibly do with the husband and wife is you have to get the lender's approval, all right? But you might be able to bring the wife in on the replacement property and make her a 99% tenant in common owner, and then you bring the husband in and make him a 1% tenant in common owner. Now, again, if the lender would go for that, then hey, you can get the loan and move forward and purchase that replacement property. All right. That brings me to the next point. Tenant in common owners can do 1031 exchanges. All right. I'll give you guys an example. What if I want to go out and I want to buy an investment property? Right. Now I want to bring somebody else in with me to help me purchase it. All right. And we're going to purchase the property as tenant in common owners, where I'm going to own 50% of the property and he's going to own 50% of the property, right? It's an investment property that we buy as tenant in common owners. Now, we buy it, tenant in common owners, right? 50-50. We hold on to that property for a period of years, however long it may be. And then at some point we decide, hey, we're ready to sell it. Now, for me, I'd like to take my 50% tenant in common ownership and I'd like to do a 1031 exchange because I want to defer my taxes and I want to buy another investment property. But my other tenant in common owner, he says, you know what? I have no desire to buy any more investment properties. I'm fine with just cashing out and paying whatever taxes are due. Well, he can do that, all right? He has that option to do what he wants. I also have the option to do what I want, right? I want to do a 1031 exchange because I want to defer my taxes, buy another investment property. I can do that. He could do his own 1031 exchange if he wanted to defer his taxes, and he could go out and buy his own investment property, all right? So tenant in common owners can do 1031 exchanges, all right? Any type of legal entity that owns real property can do a 1031 exchange, all right? Corporations, trusts, partnerships, LLCs, okay? Sometimes we see this with LLCs. Let's say I have a single member disregarded LLC. Now, disregarded meaning that LLC doesn't file a separate tax return. Anything to do with that LLC, I just put any tax information for that LLC, I just put on my personal taxes. All right, I don't file a separate tax return. So that's considered a disregarded entity because me as an individual and my disregarded LLC, my disregarded entity are considered one and the same because why? Because it's all being reported under one tax return. All right. So when you do a 1031 exchange, let's say you sell the property as an individual. All right. The replacement property, you have the option to purchase the replacement property as you as an individual, or you could actually purchase it in your disregarded single member LLC. All right. It works just the opposite way too. If you're selling the property and your disregarded single member LLC owns the real property and you sell it in that LLC, well, the replacement property, you can purchase it in that same disregarded LLC or you as an individual. Because why? Because for tax purposes, you're considered one and the same. All right. Sometimes we even see this with LLCs. Let's say somebody wants to go out and they want to buy 1234 Main Street. So what do? Well, they go out and create 1234 Main Street LLC. That's going to be disregarded, meaning that they're not going to file a separate tax return for 1234 Main Street LLC. Anything to do with that LLC, they're just going to put on their personal taxes. All right. Now, so they buy that 1234 Main Street in the name of the 1234 Main Street LLC. It's an investment property. They hold on to it for a period of years. And then at some point they say, okay, we're going to sell it. And we want to do a 1031 exchange. No problem, right? Now, the replacement property that they go out and buy, well, they're going to buy 5678 Central Avenue. Well, you know what? They don't want 1234 Main Street LLC buying 5678 Central Avenue. So what do they do in that case? Well, they go out and create 5678 Central Avenue LLC. That's going to be a disregarded entity as well. Again, they're not going to file a separate tax return for that LLC. Well, they can do that because why? Because all of those disregarded entities, those LLCs, are one and the same with each other, and they're also one and the same with the individual. Because why? Because they're all being reported on one tax return. All right. Now, if it's a multi-member partnership, LLC, corporation, and it's referred to as a regarded entity, meaning that the actual entity itself files a tax return. Typically, the entity is going to issue K-1s to all the partners, right? Well, if that entity sells the real property in a 1031 exchange, that regarded entity, that same regarded entity needs to be the purchaser in any replacement property or properties, okay? So again, whoever the taxpayer is in the sale of the relinquished property when you do a 1031 exchange needs to be the same taxpayer in the purchase of any replacement property or properties, okay? Now, property qualifications, all right? What property is excluded from 1031 exchange, all right? So we already talked what qualifies, right? Any type of real property using your trade or business or that you hold for investment, all right? You can exchange it for any other type of real property that you use in your trade or business or you hold for investment. Then those properties can be located where? Anywhere in the United States, including Guam or the U.S. Virgin Islands, all right? Property in Puerto Rico is excluded from 1031 exchange. We talked about that in the basis class, right? Now, your primary residence, that's excluded from 1031 exchange. We've already talked about that, right? What can you do for your primary? Well, it may qualify for that section 121, right? But your primary residence, you can't sell it in a 1031 exchange, exclusively in a 1031 exchange. All right, properties held for sale is excluded from 1031 exchange. I'll give you guys an example of how that can work. Let's say I'm a builder. Here in Florida, we have a lot of these like national home builders like Pulte Homes, KB Homes, Lennar Homes, all right? Let's say I'm Pulte Homes. Now, Pulte Homes, they're one of the largest single-family residential home builders in the entire country, right? They build newly constructed homes in multiple states, right? Well, the properties that they build, when those properties are completed, what do they do with them? Well, they turn around and sell them, right? Well, they can't do 1031 exchanges on those types of properties because why? Because they're holding those properties for sale and they're not holding them for investment, all right? Property held for sale is excluded from 1031 exchange, right? What are the type of properties excluded from 1031 exchange? Dealer property, all right? Dealer property could be somebody that we most often refer to as a flipper. Let's say, they buy a property, 2 or 3 months goes by, they fix it up, and then what do they do with it? Well, they turn around and sell it. Well, they can't do 1031 exchanges on those types of properties because why? Because that's like their inventory. That's the business that they're in, right? They're fixing properties up and they're turning around and selling them. Well, you can't do a 1031 exchange on those types of properties because they're holding those properties for short term, fixing them up, and they're selling them. All right. Now, what if I'm a flipper? Here's an example of how things could be a little different. What if I'm a flipper? Let's say I fix a property up. Buy it, fix it up, maybe 2 or 3 months again. And when it's completed, instead of turning around and selling it, they go to their realtor and they say, hey, can you put this in the MLS system and show it for rent? Let's make sure we put it in there. We advertise it for fair market value rent. That's going to be a little bit different because why? Because now all of a sudden they're showing their intent that they're holding the property for investment and they're not holding it for sale. All right. Hey, who knows? Maybe they even show it to a potential renter. They run some type of credit check on that potential renter. Maybe that potential renter has horrible credit, and they decide, hey, I'm not even going to rent the property to that potential renter. Right? If that flipper gets audited and the IRS comes in and says, prove to us you held that property for investment and not for sale, they're going to have to be able to back it up. All right. And in the example I just gave you guys, hey, they probably could back it up, right? They could say, look, here's an email I sent to my realtor saying put it in the MLS system for rent at fair market value. Hey, here's the MLS listing showing it for rent at fair market value. Here's the day I showed it to a potential renter. Here's the credit report I ran on that potential renter. All of that type of stuff is going to be their backup, right? Their proof, their trail of breadcrumbs to prove that they held that property for investment and not for sale, all right? But if they just strictly fix it up, turn around and sell it, you can't do a 1031 exchange on it, all right? Now, what other type of property is excluded? Well, foreign property is excluded from 1031 exchange. So I'll give you guys an example. Let's say I couldn't sell a property here in Florida in a 1031 exchange, an investment property, and try to buy replacement property somewhere in Canada or Mexico or somewhere in Europe. Okay, it has to be what? It has to be domestically located property anywhere in the United States, including Guam or the U.S. Virgin Islands, right? So foreign property is excluded from 1031 exchange. All right, so the tax deferral requirements. So in order to defer your taxes 100%, okay, rule number one is what? You must reinvest all the net proceeds in property of equal or greater value. Now, what are those net proceeds? If you remember this from the basis class, the net proceeds, that's the cash, right? That's the cash that normally you would get out of the closing. Now, we're the qualified intermediary, the QI. We're going to hold those proceeds on behalf of the seller, the exchanger, because the rule is what? They can never have receipt of those funds. If they do, they lose their ability to do a 1031 exchange, right? So they can't close today and call me tomorrow and say, hey, Jeff, I want to do a 1031 exchange. At that point, it's too late. All right. They couldn't even close today and get in the parking lot. All right. At the title company, escrow company, attorney, whoever just did their closing, that their funds may be sitting in that company's escrow account. They may be waiting to wire the funds out to them. They lose their ability to do a 1031 exchange, even at that point, because they they may be waiting to wire the funds out. In that case, they have what's referred to as constructive receipt. They have a legal right to the funds. They've lost their ability to do a 1031 exchange, right? So we have to get involved prior to closing, prior to walking out the door, basically, right? And we're going to hold those proceeds on behalf of the seller, the exchanger. What do they need to do to get a full deferral? They have to take that entire amount, those proceeds that we hold on their behalf, and they have to use that entire amount to go out and buy a replacement property, or it can even be a combination of properties where the purchase price or the combined purchase prices are equal to or greater than whatever the sales price was on the property that they sold, the relinquished property. All right, that's rule number one. Now, rule number two is you must acquire an equal amount of greater debt. Now, what exactly does that mean, right? Well, if you have a loan that you're paying off, right, you're required to get a loan of at least that amount or greater in any replacement property or properties. Now, that rule can actually have an exception, right? If you have cash that you can add to the purchase of the replacement property or properties, you can offset having to acquire any debt or any additional debt. All right. Now, obviously, if you don't have a loan that you're paying off when you sell your relinquished property, you're not required to get a loan when you buy your replacement property. But you do have the option. If you want to or if you need to, you can always get a loan to help you buy the replacement property. All right. Now, how do the numbers work? All right. So here's a quick example. All right. In our example, we're going to sell our relinquished property for $1 million. All right. Now, we have a loan that we're paying off, all right? We have the loan payoff is $300,000, so that's the debt, all right? So we take that $1 million sales price. We're going to deduct out the $300,000 for the loan, for the debt, all right? Now, we have some cost of sales of $50,000 associated with the closing. That's like real estate commissions, title insurance, closing fees, some of those non-reoccurring type of fees. Let's just say that's $50,000. All right, so we deduct out the $50,000, and that's going to give us net proceeds from the sale, all right, of $650,000. Now, again, we're the qualified intermediary, right? We're going to hold that $650,000 on behalf of the seller, the exchanger, right? Now, what are they going to do with those funds? They're going to use that entire amount, that $650,000, and in this example, they're actually going to go out and they're going to buy a replacement property for $1.2 million, right? So they're actually going up in value because why? Because they sold the property, their relinquished property for $1 million, and now they're buying a property even greater than what they sold because they're buying a property for $1.2 million. And they're going to use that entire $650,000 to help them buy the property for $1.2 million. So they just met rule number one. Now, they still need another $550,000 to help them buy that property for $1.2 million. So what do they do in that case? Well, they go out and get a loan for $550,000. By doing that, they just met rule number two because why? They had a loan that they paid off of $300,000, and now they just acquired greater debt, right? Because they got a new loan for $550,000. So in this example, they would get a full deferral. They would defer their taxes 100%. All right. Now, remember I told y'all with the rule number two, you can actually offset it with cash. Let's just say in the example, let's say they say, well, we don't want to get a loan for $550,000. If they happen to have $550,000 cash that they can add to the purchase of the replacement property, that would have worked for them too, because that would have offset rule number two of the debt. All right. Now, what if they would have said this? They said, well, we don't have $550,000 in cash. We do have some cash that we're willing to add to the purchase of the replacement property. We're going to do that, and then the difference they're going to make up in a loan. That would have worked for them as well. All right. So any of those scenarios work for rule number two. You can acquire greater debt, you can add cash to offset the debt amount, or you can do a combination of both. All right. Now, here's another example. What if out of the $650,000, they say, well, we don't want to use all of that towards buying a replacement property. All right, they want to hold some money back. They want to hold some cash back. In this example, they want to take $100,000 out of that $650,000, and they want to put that in their pocket. Right? They only want to use $550,000 towards buying a replacement property. Well, they can do that as well, right? But that $100,000 that they hold back, they're going to be subject to tax on that amount, all right? That's referred to as cash boot, right? It doesn't mean they can't do a 1031 exchange, right? It just means that instead of getting a full deferral, they're going to get what's referred to as a partial deferral. Partial why? Because they're going to be paying some taxes on that $100,000. Now, that $100,000 that they hold back, they can do whatever they want with those funds, right? They want to pay off some bills. They have a child starting college. Maybe they want to pay for college. Maybe they want to go on a great vacation. I don't know. Maybe they want to go to Vegas. They want to blow it all gambling. All right. Again, whatever they want to do with that $100,000, they can do, but they're going to be subject to taxes on that amount. All right. Now, back to the example. So that $550,000, we're going to hold that on their behalf, and they're going to use that. And actually, in this example, they're going to go out and they're going to buy a property of less value. They're only going to buy a property for $800,000. All right. Now, they still need another $250,000 to help them buy that property for $800,000. So what do they do in that case? Well, they get a loan for $250,000. But by only getting a loan for $250,000, they actually go down in debt by $50,000. They're going to be subject to taxes on that $50,000 as well, right? That's referred to as mortgage boot, right? So there's two types of boot. There's mortgage boot and there's cash boot. Again, it doesn't mean that you can't do a 1031 exchange, all right? It just means that you're going to get a partial deferral instead of a full deferral, all right? Now, typically, the taxes that you pay on the boot are going to be less than if you sold the property outright, all right? If anybody ever wants to do anything like this, I always tell them, say, look, you really need to talk to your CPA, and you got to get all your numbers, all right? Because you have to look at it and say, okay, if I don't do a 1031 exchange, if I just sell my property outright, what's my taxes look like? Now, if I do a 1031 exchange, but I pay some taxes on the boot, what's my taxes look like? Now, again, typically, the tax you're going to pay on the boot is going to be less than you just selling your property outright. But if your CPA comes back and says your taxes are actually going to be greater, if you do a 1031 exchange, the taxes on the boot are going to be greater than selling your property outright. Guess what? Don't do a 1031 exchange because it's not going to be worth your while. You're going to lose money, all right? So again, always, always, always talk to your CPA. And I talked about this in the basis class because your CPA is going to have way more information about your tax situation than I ever would and anybody else would ever know, okay? So again, always talk to your CPA. Make sure you get your numbers, all right? Now, there's some timelines everybody needs to be aware of, all right? So for when you sell your relinquished property, all right, you're going to have 180 calendar days to purchase any replacement property or properties, all right? Now, because we're past October 17th, all right, it's actually 180 calendar days or the date that you're required to file your tax return, all right? Again, because we're past October 17th, if you're required to file your tax returns on April 15th, all right, like most people, all right, every day past October 17th, April 15th is less than 180 days away. Hopefully everybody understands that. So let's say you sold your property today. Well, April 15th is less than 180 calendar days away. But if you file an extension where you're not required to file your tax return on April 15th, then you can get the full 180, all right? So it's 180 calendar days or the date you're required to file your tax return with extensions, right? Now, the first 45 days of the 180, that's referred to as the identification period. Now, you might be asking, what does that mean exactly? Well, the identification period works like this. You must identify any potential property or properties that you want to buy, right? that's something else we're going to assist with, all right? We're going to provide a form to the exchanger. It's called the identification ID letter. And on that form, there's going to be some blank lines, all right? It's going to have to be specific to a property address or addresses, all right? Exchanger is going to have to complete it, sign off on it, get it back to us by midnight of the 45th day. That's how they will formally identify their replacement property. They're going to do it to us, the qualified intermediary, right? None of those properties even have to be under contract, right? You just have to identify any potential property or properties that you want to buy. But here's the thing. Let's say you find that perfect property on day 46, okay? At that point, it's too late, all right? So whatever you put on that form, you're going to have to make sure you're going to be able to buy at least one of those properties. Okay, there is no exceptions after midnight of the 45th day. If one of those properties gets sold, we get hit with a hurricane here in Florida, and everything, it gets destroyed in a hurricane, all right? One of them burns down to the ground. There is no exceptions after midnight of the 45th day. Okay, and you have to buy that one of those properties by day 180. All right, from when you sold. All right, so you have a total of 180 days to purchase. The first 45 days of the 180 is the identification period. All right, if you're purchasing that property on day 181, you're going to be paying all your taxes. All right, if the properties you've identified by midnight of the 45th day, if you are unable to purchase any of those properties, you're going to be paying all your taxes, all right? So again, it's very specific to the 45 days to identify, a total of 180 days to purchase your replacement property, or the date you're required to file your tax returns with extensions, all right? Hopefully everybody understands that. If not, let me know. We can talk about it offline, all right? Now, there's some identification rules, all right? Now, there's 3 different rules as far as identifying goes. Now, I'm going to read each one of the rules to you, and if you don't quite understand them when I read them to you, don't worry about it, because I'm going to show you how the numbers work for all 3 of these rules, and hopefully once I show you how the numbers work, it's all going to make sense to you, all right? Now, the most popular rule that we see is referred to as the 3-property rule. All right, now the 3-property rule states this: you can identify up to 3 properties without regard to the fair market value of those 3 properties. So what exactly does that mean? Fair market value, that's the purchase prices, right? So if you identify 3 properties or less, the purchase prices can be any dollar amount. It does not matter. Again, as long as it's 3 properties or less that you identify. Now, if you want to identify more than 3 properties, you can do that, all right? But you're going to fall into this next rule. It's referred to as the 200% rule, all right? And the 200% rule states this: you can identify over 3 properties, but you cannot exceed 200% or 2 times the combined fair market value of the property being sold. So what exactly does that mean? Well, what that means is if you identify more than 3 properties, the combined purchase prices of all those properties that you've identified cannot exceed 200% or 2 times whatever the sales price was on the property that you sold, the relinquished property, all right? Now, if you want to identify more than 3 properties and you also want to exceed the 200% rule, well, you can do that, all right? But you're going to fall into the next rule, all right? It's referred to as the 95% rule. Now, it's very rare that we even see this rule enacted, all right? Some of the literature that we produce, the hard copy stuff, we don't even talk about the 95% rule. But I just want everybody to realize it does exist. It's out there. It doesn't make a lot of sense the way it's written. But let's remember, everybody, this is the IRS. And sometimes this stuff just does not make sense, all right? Because here's how it reads, all right? You can identify over 3 properties, and you can exceed the 200% rule, but you must acquire at least 95% of the value of all the properties that you've identified. Now, I know that's probably about as clear as mud, right? Let me show you other examples, especially with this last one, the 95% rule. And hopefully once I show you how the examples with the numbers work, that it'll click for you, all right, if you don't understand. All right, so here's the 3-property rule. Again, as long as if you identify 3 properties or less, they can be any dollar amount, any purchase price, all right? So here's how it works. We sell for $1 million, all right, our relinquished property for $1 million. Now we go out and we identify 3 properties, all right? So we're in the 3-property rule. Now let's just say we're going to buy each one of those for $1 million each, all right? So we identified how much in property? $3 million worth of property. Now, we could be buying each one of those properties for $10 million each for a total of $30 million in identification. Again, it does not matter. As long as it's 3 properties or less, they can be any dollar amount, right? It does not matter. But what does matter, and I'll say it again, if you identify 3 properties, boy, you better make sure you're going to be able to buy at least one of them. All right. So what's the best way to lock up a property? Is to put one of them under contract, right? So you're not required to have one under contract, but in practice, that's typically what we see is somebody will put a property under contract. That's one of the properties they identify. And then, I don't know, maybe they'll identify 2 other properties, all right, on the form by midnight of the 45th day. Because again, if after midnight of the 45th day, if the property that they have under contract, let's just say that whole thing falls apart, well, they would have the opportunity to purchase those other 2 properties that they would have identified on the form, the identification form. All right. So again, that's the 3 property rule. Hopefully everybody understands that. It seems like it's pretty straightforward. Now here's the 200% rule. Again, this is where you exceed the 3 property rule, but you cannot exceed 200% or 2 times the combined fair market value of the property being sold. So here's how it works. All right. So we sell the property again for $1 million. This time we go out and we identify 5 properties, all right? Because we've identified 5, what just happened? We've exceeded our 3 property rule, right? Which puts us into the 200% rule. So what does that mean? Well, what that means is the combined purchase prices of all 5 of those properties cannot exceed $2 million. Now, where am I getting the $2 million? You may be asking yourself. Well, we sold for $1 million, right? 200% of $1 million sales price that we sold for our relinquished property, or 2 times that $1 million sale that we sold our relinquished property for, is what? $2 million. All right, so that's where it comes in. All right, hopefully that makes sense. I think that's pretty straightforward. All right, now here's the 95% rule. Again, this is where you exceed the 3 property rule, you exceed the 200% rule, but you must acquire at least 95% of the value of all the properties that you identified. Now, here's how it works, all right? Again, we sell for $1 million. Now, this time we go out and we identify 10 properties, all right? Because we've identified 10, what just happened? Exceeded our 3 property rule, right? Now, let's keep the math simple. Let's say we're going to be buying each one of these properties for $1 million each, all right? So we've identified how much in property? $10 million worth of property, right? By identifying $10 million worth of property, what just happened? We exceeded our 200% rule, right? Because that was how much? $2 million, right? So that puts us into the 95% rule. So in our example, if we only acquire 9 out of the 10 properties, that's only 90%, or $9 million. That's not 95%, right? If we only acquire 9 out of the 10 properties, guess what happens? We blow our entire exchange and we have to pay all of the taxes, all right? So the reality of the 95% rule is really 100% of whatever you identify, you're going to have to purchase, right? And we're using really simple numbers, right? We're saying, hey, all the purchase prices are going to be even $1 million. You know what? Those purchase prices are going to be all over the map, right? It's going to be really hard to sit down and try to figure out and say, okay, let's see. Maybe I need to purchase this property. Wait, gosh, that's only going to put me at 93%. All right, maybe I may need to make sure I get this other property. Oh, that's only going to be 94%. The 95% rule is really 100% of whatever you have identified, you're going to have to buy. All right. The IRS wants to limit you in how many properties you can identify. They don't want you identifying everything under the sun, because you know what? If you identify everything under the sun, guess what's going to happen? You're going to have to buy everything under the sun because of this crazy 95% rule. All right. So if everybody gets that, if not, we can talk offline. All right. Now, everything we've talked about today, the type of exchange that we've talked about is referred to as a delayed exchange. Now, the delayed exchange is the most common type of exchange, all right? Again, it's where you sell first, all right? You sell your relinquished property first, right? Clock starts ticking, 45 days to identify, and you're purchasing your replacement property last. You're going to be purchasing your replacement property by day 180. All right, that's referred to as a delayed exchange. Again, it's the most common type of exchange. 90 to 95% all the exchanges we do are delayed. But there's a few other types of exchanges, right? There's one that's referred to as a reverse exchange, right? Now it works just the opposite of a delayed. It's actually where you buy first, you're buying your replacement property first, and you're selling your relinquished property last, right? They can work something like this. Let's say you have your relinquished property listed for sale. Now maybe you don't even have a contract on it yet, but you go out and you find that perfect replacement property, right? Now it's a seller's market, like the market we're having right now. It's a seller's market. And you know, boy, if you don't act fast, you might lose out on being able to purchase that perfect replacement property because why? Hey, it might get sold. It may be sold before you even sell your relinquished property. So what can you do? Well, you can do this thing called the reverse exchange. What happens in the reverse exchange is we actually come in and we form a separate company. We form an LLC, right? It's also referred to as an exchange accommodation title holder, EAT for short, right? We come in and we purchase the replacement property before you sell your relinquished property, right? Now, when we do that, if there's tenants in the property, right, and there's rent money coming in, income coming in every month, we can actually even do a triple net lease back to the exchanger, all right, so they can benefit from any lease monies that are coming in, all right. Now, once we purchase the replacement property, you must be able to sell your relinquished property within 180 days, all right? So there's the 180 coming back into play. It never goes away in 1031 exchange, all right? What are some of the advantages, the positives of doing a reverse exchange? Well, positive, as I mentioned, in a seller's market, when you have to act fast, you can save and get that perfect property, right? Assure that you get that perfect property. What if you did this? What if you list your property and you think, wow, my property is the greatest property in the world. I'm not going to have any problems selling the property. So what do? Well, you go out and you put a contract on a replacement property. And then reality sets in, right? You slowly but surely you realize, gosh, maybe I don't have the greatest property in the world because I'm not getting all those showings like I thought. I'm not getting all those offers like I thought. But guess what? You have a contract on a replacement property, and that closing date is fast approaching. You're obligated to buy that property. So what can you do? Well, you can do this thing again called a reverse exchange. All right. Now, what are the negatives? What's the biggest obstacle to overcoming a reverse exchange? Well, the financial part is the biggest obstacle. We're a great company, right? But we're not just going to come out of pocket and purchase the replacement property. That exchanger is going to have to be able to give us the financing to do that, all right? Typically, it's going to have to be cash. Now, why do I say cash? Because if they're dealing with a traditional lender, traditional lenders are not going to loan funds at that point. Because why? Because, hey, we're not the borrower. The exchanger is, all right? We're actually going in title. They aren't, all right? Traditional lenders aren't going to loan funds at that point. That's why I say, hey, they're going to need to be able to give us cash. Now, maybe they have some kind of great banking relationship. They can get some type of line of credit. Some of these hard money type lenders, people tell me, will do deals like that all day long. For us, it doesn't really matter. Just some way, somehow, the exchange is going to have to be able to give us the financing to be able to buy that replacement property. All right. Now, what's the other negative? Well, I already mentioned it. You have to be able to sell your relinquished property within 180 days. Now, what happens if you don't sell your relinquished property in 180 days? Well, you're going to own two properties. All right. We're not going to hold on to it. All right. You're going to own two properties. Now, you're not going to have any capital gains taxes or anything else associated with that. Because why? Because you never sold anything, right? All right, but ultimately you're going to own two properties. Now, if you do want to you still want to sell that investment property, well, you can do that, right? You can do a 1031 exchange, but guess what? You're going to have to designate a new replacement property because at that point you will have already owned the original replacement property, and with exchanging, you can't exchange it to something you already own. All right, so that's how a reverse exchange works. Now, there's another type of exchange. It's referred to as a construction exchange, right? Another term you may hear people refer to it is an improvement exchange or even a built-to-suit exchange. They can work something like this. Let's say you sell your or relinquish property in a 1031 exchange, right? Now, we're the qualified intermediary. We're going to be holding the proceeds from the sale. You go out and you find a replacement property, but it's not everything you want. You want to do some improvements to it before you actually acquire it. Well, you can do this thing called the construction improvement built to suit exchange. Again, we come in, we form that LLC, that EAT. We can take the proceeds that we're holding and we use those proceeds to buy the replacement property. And then we oversee any construction, any improvements to it, all right? We're working with the contractors. We're paying the contractors, all right? They're submitting invoices. We're working with the exchanger. We're working hand in hand with them. They're letting us know who needs to be paid and that type of thing, all right? But we're involved with the construction process, all right? All those improvements need to be done within 180 days. So there's the 180 coming back into play. Again, it never leaves. It's always there in 1031 exchange. All right. So that's called the construction improvement built to suit exchange. All right. Now, what are our fees? What do we charge for our services? Well, on a delayed exchange, again, that's the most common type of exchange, right? It's where you sell first. You're selling your relinquished property first, right? Clock starts ticking, 45 days to identify, and you're buying your replacement property by day 180, all right? We charge $750 on the sale, all right? Now, we don't collect anything until it physically closes, all right? For those of y'all on the line that are realtors, you don't earn your commission until it closes, right? Neither do we. We don't earn our $750 until it physically closes. Now, if we get everything set up prior to closing, the contract cancels, the buyer walks, whatever may happen, it never gets to closing, we don't even charge any kind of cancellation fees. We don't charge any type of wiring fees, anything like that. We charge $750 in the sale. And when they buy their replacement property, okay, we charge $250. And we don't collect anything in that case until it physically closes. So if you sell one property, you buy one property, our total fee is $1,000. That's it. Right? It could be a $100,000 property, could be a $100 million property. That's our standard fee. All right. Now, for the reverse exchange, the construction, the improvement exchanges, built to suit, all right, our fee for those types of exchanges, they start off at about $6,500, all right? They can be significantly more complicated, all right? We're forming an LLC, right? We're going on title. With the construction exchange, we're working with contractors, we're paying the contractors, we're overseeing construction, all right? They can be significantly more complicated. Remember, I mentioned to y'all in the very beginning, one of our owners is a tax attorney, Adam Skarsgård. Adam personally handles any reverse or construction improvement exchanges built to suit that we do. He looks at each one of them individually and decides on the complexity and bases our fee off of the complexity, all right? But again, they start off at about $6,500, all right? That's it. We're doing good on time. We finished 2 minutes early, all right? So I'll open the floor up to questions. All right. If y'all have any questions, just feel free to type them in right now. And while we're waiting for the questions to come in, I'll mention this again. Everything we talked about today has been recorded. You're going to receive a link to today's recording if you want to refer back to it at a future date. And again, I'm going to get those PDFs out to everybody. A lot of the various topics we talked about, I have in PDF form. I'll email it over to you. If you have clients, don't feel like you have to be a 1031 exchange expert by any means, right? I'd be glad to talk to your clients about 1031 exchange. I talk to people about 1031 exchange all day long, all right? You as an individual, if you're an individual investor, I'd be glad to talk to you as well. That email that I'm going to send out to everybody, if you want to forward that on to your clients, sometimes people will forward that on to their clients. They CC me on the email. And then I can take it and run with it. I can take it over if you'd like for me to answer any questions your clients may have. And then also, for those of y'all on the line that are realtors in the state of Florida, I do have a 2-hour continuing ed class. It's approved for classroom style in person. The state has they issued like an emergency order for the last 6 months. I've been able to do it as a webinar. I'm still waiting to see if they're going to extend it to the end of the year. This class, the advanced class, I also have a basis class. I do those in person. I do them as webinars as well, like today. If you think other realtors in your office would benefit from me coming in to do that, I'm not doing the live classes, but I can do the webinars just let me know. If you, I'd be glad to email you some information about the various classes. If send it on to your broker. Even if you're a title company, I do for boards of realtors. Just let me know, and we can set up a date and time. Okay, let's see. We have a question. Can you also email the info on the first webinar that I missed? All right, Mary, if you can send me an email, because once I close up today's presentation, I'm not going to have access to any of the questions. All right, so yeah, I'd be glad to email y'all out the links if y'all want for the basics class. I do these classes like twice a month, so I'm gonna do another live class in November. I'm gonna do the basics. I'm gonna do the advanced. If you'd rather just attend the actual live class, be on the lookout for it. All right, I don't have those dates yet. I'm trying to figure it out. With the holiday, Thanksgiving mixed in there, trying to figure out what dates I'm going to do the classes. But I do these twice a month. I was doing the continuing ed class as a webinar during the month as well, but I can do them for your individual offices if you like. All right. Okay. It looks like they don't have any other questions. But if something pops up after we hang up, just feel free to shoot me an email, give me a call. My contact information's up on the screen. If you have a complicated question, it's kind of hard to type it in like 30 seconds. Hey, no problem. Let's talk on the phone, or you can, if you want to email me, take a little bit more time. That's what I'm here for. I'd love to be your 1031 exchange resource. All right. But we'll go ahead and wrap it up for today. We're 1 minute over, so we did great on time. Again, thanks for attending, everybody. Again, in the future, if you have any questions, feel free to reach out to me. I'm going to get those PDFs out to you. I'm also going to get the link out to you for today's class. But if there's anything I can do for you, please just let me know. So thanks for joining. Hopefully everybody stays safe, stay healthy, and hopefully we'll talk soon. Thanks again. Okay, bye-bye.